It happened, the unthinkable. The day the market stood still, paralyzed by a single earth-shattering event. On a seemingly ordinary Tuesday morning, the financial world froze. Trading screens flickered, displaying numbers that no one could quite believe. A hush fell over the usually bustling trading floors, as the implications of what was unfolding began to sink in. Warren Buffett, the Oracle of Omaha, the legendary investor whose name is synonymous with sound financial principles, sold every single publicly traded stock in Berkshire Hathaway's portfolio. A portfolio carefully constructed over decades, representing a who's who of American industry. Gone, liquidated, every single share, sold off in a move that defied all expectations. All of it turned into cash, mountains of it, a war chest of unprecedented size, sitting idle while the rest of the market churned. Headlines exploded, Buffett cashes out. The stark, simple message reverberated around the globe. The end of an era. A dramatic pronouncement, but one that many felt captured the gravity of the situation. It was like your sensible grandfather selling his house and moving to Vegas. Unthinkable. A complete departure from everything he stood for. We're talking hundreds of billions in shares. A staggering sum of wealth suddenly removed from the market. Apple, the tech giant that had become a cornerstone of Berkshire's portfolio. Bank of America, a financial institution that Buffett had famously rescued during the 2008 crisis. Coca-Cola, a brand synonymous with long-term value and consistent returns. American Express, another blue-chip company that had been a fixture in Berkshire's holdings for decades. All gone. Vanished from the portfolio, leaving a void that sent shivers down the spines of investors worldwide. This wasn't a rumor, a fleeting piece of gossip on the trading floor. It was a real verified SEC filing, official documentation confirming the unthinkable. The man who said his favorite holding period is forever just sold everything, a complete contradiction of his own well-established investment philosophy. Shockwaves hit instantly. The market reacted with a speed and ferocity that few had anticipated. Analysts scrambled, desperately trying to make sense of the situation. Models were rerun, assumptions were questioned, and the search for answers began in earnest. Investors panicked, selling off their own holdings in a knee-jerk reaction to Buffett's move. Fear gripped the market and the dominoes began to fall. For decades, Buffett was the bedrock of investing wisdom. His words were gospel, his actions closely scrutinized and emulated. His strategy, a simple yet powerful approach that had generated unparalleled returns over the long term. Buy great companies, hold long term, stay calm in chaos. A mantra that had guided generations of investors through turbulent times. He weathered every storm, from Black Monday to the dot-com bubble, emerging stronger and wiser each time, always buying when others were fearful. A true contrarian, he saw opportunity where others saw only risk. So why sell it all now? The question that echoed through every boardroom and trading floor. It felt like a law of investing had been broken, a fundamental principle, shattered into a million pieces. The question on everyone's mind, the one that dominated every conversation and filled every headline. Why, a single word, laden with uncertainty and fear. What does Buffett see that we don't? What hidden risks? What looming threats? Has he identified that the rest of the market has missed? Is this a signal of a coming crash? A harbinger of an economic downturn of unprecedented scale? Or is he preparing for the greatest buying opportunity ever? Is he poised to swoop in and acquire assets at fire sale prices when the market finally hits rock bottom? Speculation ran wild, fueled by fear and uncertainty. Rumors spread like wildfire, each more outlandish than the last. But one thing was clear, regardless of the reason, the implications were enormous. When Buffett moves, you pay attention. His actions carry weight, his decisions shape markets. This wasn't just a portfolio change, it was a statement, it was a seismic event, a financial earthquake that shook the foundations of the global economy. The world wanted answers, desperate for some explanation, some reassurance in the face of such unprecedented action. And everyone, from Wall Street to Main Street, was left wondering what comes next. The uncertainty hung heavy in the air, a palpable sense of unease that permeated every corner of the financial world. When the oracle speaks, you listen, but when he acts, the world holds its breath. So, when we hear that Warren Buffett is selling everything, what does that actually mean? It's a headline that grabs attention, but the reality is far more nuanced than a simple fire sale. Let's break this down and understand the specifics of what's happening with Berkshire Hathaway's portfolio. First and foremost, Buffett didn't sell Berkshire Hathaway itself. The core of his empire remains intact. Berkshire Hathaway, the massive holding company, continues to operate and oversee its diverse range of businesses. The company still owns businesses like See's Candies, the beloved confectionery known for its chocolates and loyal customer base. This is a classic example of the type of stable, cash-generating business that Buffett favors. Geico, the insurance giant, a cornerstone of Berkshire's financial strength, providing consistent profits and a significant market share in the competitive auto insurance industry. Dairy Queen, the iconic ice cream and fast food chain, a brand recognized and enjoyed by generations, contributing steady revenue and brand recognition to the Berkshire portfolio. And BNSF Railway, one of the largest freight railroad networks in North America, essential for transporting goods across the country and a vital component of the American economy. Those core businesses remain untouched. These are the pillars upon which Berkshire Hathaway is built, and they continue to operate as usual, generating revenue and contributing to the company's overall value. What he sold were the publicly traded stocks, the shares Berkshire held in other publicly listed companies. Berkshire's massive stock portfolio. This portfolio, worth hundreds of billions of dollars, is where the significant changes have occurred. Think of Berkshire as having two parts: a collection of wholly owned companies and a portfolio of investments in other businesses. Whole companies, businesses that Berkshire owns and controls outright, like those we just mentioned. And pieces of public companies representing smaller ownership stakes in publicly traded corporations. It's the second part, the stock holdings, that has been significantly reduced. That's now all cash. The proceeds from these stock sales have been converted into liquid assets. Berkshire is now sitting on a cash pile, an enormous reserve of capital ready to be deployed, likely exceeding $500 billion. This is an unprecedented level of liquidity for Berkshire Hathaway. That's more than the GDP of many countries. To put it in perspective, Berkshire's cash hoard rivals the economic output of entire nations. This cash isn't stuffed under a mattress. It's not just sitting idly. It's in short-term U.S. Treasury bills, government debt that matures in a short period. The safest, most liquid assets available, ensuring the preservation of capital while providing a small return. Buffett has swapped ownership, exchanging equity positions in America's greatest companies, some of the most well-known and successful businesses in the world, for a mountain of government IOUs. He's essentially betting on the stability of the U.S. government. This isn't panic. This isn't a knee-jerk reaction to market volatility. It's a calculated strategic pivot, a deliberate shift in investment strategy based on Buffett's assessment of the current economic landscape. He's moved away from stocks and into cash, reducing exposure to the equity market, waiting for the right moment, patiently observing the market, and preparing to act when the opportunity arises. The real question, what's he planning to do with all that money? What is the end game here? Is he bracing for disaster, anticipating a significant market downturn, or preparing for a legendary opportunity, a chance to acquire undervalued assets at bargain prices? The world is watching, eager to decipher Buffett's next move and understand the implications for the global economy, and the stakes couldn't be higher. The decisions made by Berkshire Hathaway have far-reaching consequences, impacting markets and influencing investor sentiment worldwide. Is this the biggest market timing call ever? Maybe Buffett believes the market is dangerously overvalued, a bubble ready to burst. He's always said, "Be fearful when others are greedy." Maybe he sees maximum greed right now. The numbers valuations ratios could be flashing red. He's not guessing, he's calculating risk, and he's not willing to bet on even the best companies. If he's right, the coming downturn could be brutal. Selling everything isn't trimming risk, it's bracing for impact. Only time will tell if this is genius or overcaution. What if this isn't about market timing at all? Buffett has a unique view of the economy through his companies: railroads, insurance, retail. He sees real-time data before anyone else. Maybe he's spotting a slowdown. Freight volumes dropping, insurance claims rising. It's not just about high stock prices, it's about the real economy showing cracks. If Buffett's data signals trouble, he's moving to safety before the headlines catch up. This is more than a bubble. It's a warning of deeper economic pain. He's fortifying Berkshire for a storm he sees coming. Should we be preparing too? Sometimes the smartest move is to listen to the mechanic who hears the engine knock before anyone else. Or maybe this is the ultimate value play. Buffett's a patient hunter. For years he's complained about a lack of bargains. By selling everything, he's built the biggest war chest in history. If a crash comes, he'll be ready to buy the world's best companies at fire sale prices. Or maybe he's eyeing a massive private acquisition, something so big he needs all the cash he can get. This isn't running from danger, it's waiting for the perfect pitch. When the opportunity comes, he'll swing hard. It's classic Buffett patience, discipline, and readiness. Sometimes the best defense is a well-timed defense. He's not just protecting capital, he's preparing to strike. To truly understand this move, you have to get inside Warren Buffett's head, to see the world as he does. It's not just about numbers and spreadsheets, it's about understanding his deep-seated philosophy. He's remarkably emotionally detached from his investments. This isn't to say he doesn't care, but he views them with a cold, calculating eye, free from sentimentality. For Buffett, stocks are just pieces of a business. They represent real-world companies with assets, liabilities, and the potential to generate profits. He's not trading symbols, he's investing in enterprises. If the price isn't right, if the market misprices the value of that business, he sells, no matter how long he's owned it or how attached he might seem to be. Opportunity cost is key to his decision-making process. Every investment he makes has to be weighed against all other possible uses of that capital. For Buffett, every dollar tied up in stocks is a dollar not readily available for a potentially better deal, a more lucrative opportunity that might arise in the future. With significantly higher interest rates, his massive cash reserves now earn billions of dollars virtually risk-free, providing a substantial return while he waits. Patience isn't just a virtue for Buffett, it's his superpower, the foundation upon which his entire investment strategy is built. He's incredibly comfortable waiting, sometimes for years on end, for precisely the right moment to deploy his capital, never feeling pressured to act. He often describes the market as a no-called strike game, where there's absolutely no penalty for not swinging. In other words, you don't have to swing at every pitch that comes your way. You can afford to be incredibly selective and wait for the perfect opportunity. This move, this strategic shift in his portfolio, is the ultimate expression of that patience and discipline, a testament to his unwavering commitment to his core principles. At 94 years old, maybe this is his final and perhaps most important lesson to investors around the world. Above all else, prioritize the preservation of capital. Protect your downside and the upside will take care of itself. His golden rule, the foundation of his investment philosophy, never lose money. And the second rule, equally important, don't ever forget rule number 1. Ultimately, he's safeguarding the long-term future of Berkshire Hathaway, ensuring its continued success for generations to come. He's not chasing fleeting short-term gains or succumbing to market pressures. It's the unmistakable mark of a true steward of capital. A responsible and thoughtful approach to investing that prioritizes long-term value creation. The biggest lesson? Cash isn't trash. For years we've heard that holding cash is foolish because of inflation. But cash is more than an investment, it's an option, a strategic tool. It gives you power to act when others can't, and safety in a downturn. Buffett's cash pile is the world's largest emergency fund. He's ready for a rainy day or a flood of opportunity. You don't need to sell everything but rethink your relationship with cash. A healthy cash reserve isn't lazy, it's smart. It lets you buy when others panic. Respect cash, build your emergency fund. When chaos hits, you'll be ready to act, not react. That's the foundation of opportunistic investing. Another lesson: be flexible. Buffett's famous for his rules, like, our favorite holding period is forever. Yet he just broke that rule. No principle is sacred if reality changes. This is a masterclass in avoiding dogma. Even the best strategies have limits. Conditions change, and so must you. Regularly question your assumptions and adapt. Don't be loyal to a stock or strategy that no longer serves you. The smartest investors change their minds when the facts change. Buffett's move is a reminder: be a critical thinker, not a blind follower. The final takeaway: prepare, don't predict. Buffett isn't trying to guess the market's next move. He's building a fortress for any scenario: recession, sideways market, or opportunity. Most investors obsess over predictions. Buffett obsesses over preparation. Preparation means cash reserves, diversification, and owning quality assets. Don't put all your eggs in one basket. Focus on what endures, assets that generate real value. Buffett's move is a wake-up call. Stop gambling, start building, save more than you spend, avoid dumb debt, keep a cash buffer, and invest for the long term. If you do that, you don't need to predict the future. You'll be ready for anything. That's how you sleep well at night, no matter the headlines. The Oracle has spoken. Now it's your move. This is Cash Me If You Can, the channel where we make money simple, smart, and sometimes funny. If this video helped you out, hit that like, subscribe, and leave a comment down below. I read them all. See you in the next one.